This is the study session on financial reporting and analysis and the reading on income taxes. Before we get to the slide deck, let me just remind you that we've talked about income taxes in previous readings. On the income statement, we called it a tax expense. On the balance sheet, we called it a tax liability. On the cash flow statement, we called it an operating cash outflow. So we have spent some time talking about income taxes, but we really didn't kind of dive in to the depths of the implications of income taxes on financial reporting and analysis, which is what we're going to do in this reading. Now, the big difference here is that businesses can use one set of accounting rules to report to its shareholders and a different set of accounting rules to report to the taxing authority. And so those differences are going to cause problems. And so it's not really just as simple as a one line item amount, tax expense or taxes payable or tax cash outflow. And so let's go ahead and look at some of these LOSs to illustrate those differences. All right, first LOS is a long one. It asks us to describe differences between and among all of these different terms. So I have two slides with these terms on them. Accounting profit is simply the company's income before taxes, as reported on the income statement in accordance with all of the prevailing accounting standards. All right, taxable income, on the other hand, is that portion of a company's income that is subject to income taxes. And this is in accordance with the tax laws of that jurisdiction. Now, sometimes accounting profit and taxable income, sometimes they might be the same number, but sometimes they might not be. And so it's that condition under which those two numbers are different that we're going to have some additional considerations for our discussion on income taxes. All right, so the payable, those are the taxes that have yet been paid. Tax expense is what shows up on the income statement. Now, here's what happens when those two, let me swing back there, when accounting profit and taxable income are not the same number, then we have an issue. And we call this thing either a deferred tax asset or a deferred tax liability. So a deferred tax asset arises when a company's taxable income is greater than its accounting profit, resulting in an excess amount being paid for income taxes. So think of it this way. We paid too much today, which means we're going to get a break tomorrow or next month or next quarter or next year, whatever that is. And so we're going to be able to use that future asset to lower our taxable income at some point in the future. So we call that a deferred tax asset. Deferred tax liability is just the opposite. And these two things arise in a variety of manners. I have a slide here that will illustrate some of those, but the key one, and I want you to focus on this as you go through the reading, is differences in depreciation methods. A company can use, let's say, straight line to report to one group and an accelerated depreciation method to report to a different group. And so, of course, if there are two depreciation expenses, then there are going to be two different tax liabilities and tax expense and all that kind of good stuff. I have a couple of really good examples to illustrate that coming up shortly. A valuation allowance is a reserve created against those deferred tax assets, and it's really based on the probability that those deferred tax assets will be realized in future accounting periods. We're going to learn that some of these things are temporary, some of these things become permanent. The tax base can be applied to both the asset or the liability as an amount which is valued for tax purposes, and the carrying amount is the amount in which it's valued according to the principles of accounting theory. So what causes the differences between accounting profit and taxable income? Here are a couple of examples. Revenue recognition and expense recognition One happens in one period, another happens in a different period. Tax basis for assets and liabilities might be different. The deductibility of gains and losses of assets and liabilities may vary depending on which method. And then there are tax loss carry forwards. And of course, these are in addition to the depreciation material that we just talked about. All right, so here's a good slide. Explain how deferred tax liabilities and assets are created, and then talk about some factors here. All right, so look down the left-hand column. If the accounting income is greater than taxable income, that means that we are going to have future taxable amounts. That means we're getting a break today for the differences between those two choices that we make, which then means that we're going to have a future tax liability. And so the accountants just call that a deferred tax liability, which means that at some point, someone's going to come knocking at our door like a government official and say, hey, by the way, remember that in the old days, I gave you a tax break. Well, now it's time to kind of make up that difference. And then, of course, just the opposite occurs if the accounting income is less than the taxable income. These are future amounts that are going to lower that tax liability. So we call that a deferred tax asset. So just think of these deferred as something that we're either going to own or that we're going to owe in the future. Now, comma, of course, some of those are temporary and they will be reversed. Some of those become permanent. All right, so look at my last bullet point. Temporary differences will reverse out in one or more future periods. And the easiest example of that is if a company has a machine, say they have a 5-year machine, and they use different depreciation methods for shareholders and for the government accounting office, that those early tax benefits are going to catch up to them as future tax liabilities. And so those temporary differences will reverse out, of course, as long as the firm uses the asset until its useful life has expired, and all those good things that accountants make us memorize for the rules of depreciation. Now, those of you who've been paying attention know that we like to use the Nike's annual report. So here, if you look on Nike's 2017 annual report, looking at the balance sheet, there's deferred income taxes and other assets in 2017. There's 2732. And then under liabilities, deferred income taxes and other liabilities, there's 1687. And so those for Nike probably relate to, let me just swing back here, one of these four things plus those differences in depreciation. Now here's a good example. So the LOS asks us to explain and then to determine how those deferred tax liabilities and deferred tax assets should be treated for the purpose of financial analysis. All right, so let's look at Prudential here. December 31st, 2018, which is coming up in just the very next week or so. Here we've got revenues of $10 million. And then we're going to compute straight line depreciation as $2 million, but accelerated depreciation as $3.2 million, and then we have some other expenses of $5 million. All right, so here's the key. Notice that it is underlined. Prudential uses straight line depreciation for financial reporting and accelerated depreciation for income tax reporting. There's a tax rate. And so the question at the bottom of the slide asks us, is there going to be a deferred tax asset or a deferred tax liability? And of course the answer is, it has to be one of those two, because clearly $2 million is not the same as $3.2 million. And so here's what happens. So I've duplicated the first box up at the top there, the $2 million and the $3.2 million. But then in the second box, I've got the income statement that we're reporting to the shareholders, and then the tax return statement that we're reporting to the government. So we use the $2 million depreciation for shareholders and the $3.2 million depreciation, which of course lowers our tax liability. And so notice that the income taxes for the shareholders is $900,000, and Our income tax payable to the IRS, if we're in the United States, is $540,000. And so the difference between the 900 and the 540 is 360. And that's going to be a deferred tax liability because we're getting that benefit today using the accelerated depreciation method. But then when the accelerated depreciation method kicks in and those higher percentages then become lower percentages in the later years of the life of the asset, we're going to have higher taxes payable. So we know this. We know that our decision to use these two different methods is going to have consequences in the future. But of course, as any good chief financial and chief executive officer will tell you, businesses would much rather have the tax benefits today rather than the tax benefits in 2 or 3 or 4 years, because of course it's a time value of money difference at least, not to mention things like liquidity and opportunity costs. Now, what happens if we flipped our decision? If we use straight line depreciation to report to the IRS and accelerated depreciation method to report to the shareholders, well, then the numbers are going to be exactly the same, but they're going to be flipped. So we're going to have $540,000 as a tax expense on the income statement, but $900,000 as taxes payable. And then, of course, because we're paying, think of it, we're kind of paying too much in taxes now, we're going to have the ability to have a lower tax liability at some time in the future. So we call that a deferred tax asset. So there's $360,000 under the deferred tax asset. So let me toggle back and forth here. These are two pretty good slides to illustrate the difference between straight line and accelerated depreciation. And of course, this holds true no matter what two different methods of depreciation that a business uses. They're going to be different numbers. And so there's either going to be a deferred tax liability or a deferred tax asset. All right, how about calculating the tax base of a company's assets and liabilities? Let's start with the assets. Remember, the tax base of an asset is the amount that will be deductible for tax purposes. And this is true because as time goes by, those future economic benefits are going to be realized. So let's suppose we've got equipment that costs $100,000, depreciation expense on the income statement, depreciation expense on the tax return. So we've got $10,000 on the income statement. We've got $25,000 that we're showing the taxing authority. And so at the end of the first year, we take the original cost of the equipment, subtract out that $25,000 that we reported to the government. So the tax base is $75,000, but the carrying value is only $90,000. Now, for liabilities, it's just a little bit easier, a little bit simpler. The tax base of a liability is the carrying amount of the liability less any amounts that would be deductible for tax purposes. Suppose we have a loan of $750,000. We took this loan out during the current fiscal year, interest rate 11.5%, and interest is payable at the end of each fiscal year. So the carrying amount of the loan is equal to the tax base, so that's $750,000. The tax base of interest on the loan is just a zero since we're paying this at the end of the year. And then loan repayment has no tax implications. How about if we continue on with this LOS? We've done the calculate, right? Calculate income tax expense and payable and deferred tax assets. We did that here. Let me just go back and remind you. We did that right here on these two slides, those two right there. So we've hit the, whoops, I went one too many. All right, so let's talk a little bit about interpret the adjustments to financial statements related to a change in the income tax rate. All right, so this is going to be important. If the income tax rate changes, then of course it's going to change the carrying amounts of the deferred tax assets and the deferred tax liabilities. All right, so here's the deal. When the income tax rate changes, deferred tax assets and deferred tax liabilities have to be adjusted to the new rate. Of course, that makes perfect sense. And so an increase in the income tax rate will cause deferred tax assets and deferred tax liabilities to increase. And of course, the opposite happens when there's an income tax decrease. All right, temporary differences are differences between those two amounts that we've been talking about in those last couple of slides. And so those differences will result in deductible amounts in the future, of course. Examples include estimated losses and expenses. Examples include unearned revenue and then rent collected in advance. And so some of those differences are going to cause future deferred tax liabilities, and examples here are the accelerated depreciation on the tax return. All right, so remember the top part there, that's going to create the deferred tax asset, and the bottom example is going to create a deferred tax liability. And so remember what I said early on in this slide deck, the key difference here is that difference in the methods of depreciation. So remember, if we accelerate, that's going to create a deferred tax liability, and then we're going to create a deferred tax asset with those examples at the top of the slide. All right, here's an example. Let's suppose that Nike has accounts receivable of $100,000, but the recovery department estimates that out of this amount, $10,000 is bad debt. Now, remember back in the old days in accounting, you would get out your journal entry and you would say, okay, $10,000 bad debt expense, $10,000 allowable for bad debts. But we need to be just a little bit more specific here. Remember now, the company will be allowed to record a $10,000 expense. But this expense will not be eligible for the actual deduction until it is proven that the relevant debtors indeed won't pay up. All right, so we're going to record that $10,000 expense on the income statement that we show the investors and our shareholders and our bondholders, but not to the IRS. So this is going to create a temporary deferred tax asset. Since the carrying amount, of course, the 90 is going to be less than the tax base of 100. All right, so this is a really cool example to give you the sense that one thing you tell your shareholders and the other thing that you tell the government, these have implications. Now, how about if these temporary differences are not able to resolve themselves just kind of naturally? You know, back here, this example with the bad debt expense is going to resolve itself naturally if those $10,000 worth of creditors actually don't pay. But, you know, suppose 9,000 of that 10,000 pays. Well, then you have to do a whole reversal. And that's why you report one thing to the shareholders and one thing to the government. But what if these things become permanent? All right, so permanent differences are created when an income item is included in taxable income or in accounting income, but will never be included in the computation of the other. So never. So let me just go back here really quickly. So sooner or later, actually, let me go back to this dude here. So sooner or later, when we've got the two methods of depreciation, if we hold the asset if we don't sell the asset, and if we keep using the asset, those differences are going to resolve itself. But if they do not resolve themselves, then they become permanent. So here we go. Income or expense items that are not allowed by tax legislation. You know, the federal government could come along, the IRS here in the United States could come along and say, okay, you're no longer allowed to deduct the cost of digging the oil out of the ground if you're an oil company. Well, clearly companies like ExxonMobil, they have tons and tons of shovel expense or drilling expense, whatever they call those things. And so, boy, that would become a permanent difference. And then there are some expenditures that result in tax credits. And then, you know, we talked about municipal bonds back in the one of those investments readings, because that interest on municipal bonds doesn't have to be reported to the IRS. All right, how about a valuation allowance? So a valuation allowance account is required when it is more likely than not. Boy, that sounds an awful lot like a lawyer got a hold of this. When I hear that term, more likely than not, I always think of 51%. I'm not sure if I'm supposed to think of it in that way, but more likely than not, mathematically sounds like 51%, that some portion of the deferred tax asset will not be realized. All right, so then the deferred tax asset is reported at its net realizable value, so whatever you can reasonably expect to get out of it. And that creation of the valuation allowance reduces the deferred tax asset and income in that particular period. That should make perfect sense. Current taxes payable or recoverable are determined using the relevant tax rates on the balance sheet. However, the deferred taxes are measured at the tax rate that is expected to be applied when the asset is realized or the liability is settled. So remember that if we're using 20% today and we're getting some extra allowances for accelerated depreciation, and we know we have that deferred tax liability in the future, well, we need to estimate those deferred tax liabilities based on what we think that tax rate is going to be. And of course, here in the United States, depending on who is president and who is running the Congress, we've got one party who wants taxes to do one thing and another party who wants taxes to do another thing. So this is a big deal. And I'm certain that it's a big deal in all countries throughout the world. Now, deferred taxes and income taxes should always be recognized on the income statement unless they relate to taxes or deferred taxes that are charged to equity or whenever there's a merger or an acquisition. The next LOS asked us to analyze disclosures. Remember back in one of the first readings in this study session, we talked about the importance of, the income statement and the balance sheet, but then we talked about the importance of all of the extra stuff that comes involved in explaining what goes on and what goes into the creation of those financial statements. So it's important to figure out how those disclosures affect the financial statements and the financial ratios. All right, so why are these disclosures so important? Of course, these disclosures can highlight the income tax provision that is current and indicate if the net income tax provision results from the offsetting by deferred tax assets. So that's really important. How about the derivation of deferred tax assets and liabilities and a valuation allowance, and then if there are any operating loss carry forwards or maybe some unused tax credits. So the disclosures are going to explain some of that financial data that we can see right directly on the income statement or the balance sheet. And here's a direct example from Nike's annual report. There's a discussion on a deferred tax liability and tax benefit, and we've highlighted those over on the blue. Now, what happens if there's a change in the federal tax rate? What this means then, that it is going to imply that if we have those deferred tax assets that we're expect to be getting in the future or realizing in the future, well, they're going to become less valuable. Of course, they're going to be less valuable if there's a change in that tax rate. A reduction in the valuation allowance could lead to a reduction in the income tax provision or a reduction in reported income taxes. And then a deferred tax liability should be classified as debt if it is not expected to reverse, and then it should be treated as equity. Now, one of the common LOSs in all of these financial reporting readings is the difference between U.S. standards and the international standards. All right, so under the international standards, all deferred tax assets and all deferred tax liabilities are classified as non-current. However, under the U.S. system, the deferred tax liabilities and deferred tax assets are classified as either being current or non-current based on whatever that related asset or liability is. Now, under recognition, in the international standards, deferred tax assets are only recognized in the event that they're going to be a probable realization. US GAAP is that more likely than not. So probable and more likely than not, that's a big difference. Tax rates in US are the enacted rates. Under the international standards, they are the enacted or substantively enactive. And then what happens if there are uncertain tax provisions? US GAAP outlines a two-step recognition and measurement approach, and the international standards really provide no specific guide. And that takes us through the income tax reading, and we'll do long-term liabilities next.